Okay, so here in corporate restructuring class, you will have to remember a lot of new terminologies. I say new because I'm not even sure your previous subjects prior to the review have mentioned some of these terminologies. So unlike the other topics wherein there will be a lot of computations here, it will be more on remembering new terms. And it's not really a big problem because they're not very um, in coming up with the terms they assign to certain strategies. The names assigned are very sensible. Like it makes sense to what they are trying to describe. So with the help of a little bit of common sense, class, it should be fairly easy for you to match the strategy being described with the terminology that is being used in the corporate world. So our goal for today is to encounter as many of those terminologies and to be able to remember them so that when they come out, you'll be able to answer the questions. So basically, several questions will come from this topic, which we will categorize as easy because they simply involve definition of terms or simply name recall. Okay, so hopefully you'll be able to take advantage from these questions. So for number one, which of the following statements about leverage buyouts is not correct? Letter A leverage buyout is less risky than other types of purchases. Letter B, in a leverage buyout, the assets of the company are used as collateral for the loans needed to finance the purchase. Letter C, a leverage buyout is often used when a company is purchased by its management team. Letter D, a leverage buyout is often used to take a company private. So only one out of these four statements will be considered for as far as leverage buyout is concerned. So what do we do in a leverage buyout? So it's basically a purchase transaction, and to make the purchase, the source of the financing will be from your debts or borrowings. So what will happen here is that the company will incur large amount of loan in order to buy back its outstanding shares. Okay, so shares that are in the hands of the public or outside parties are bought back so as to eliminate outside control. But the problem is the financing used is through borrowing. And as you should have an idea by now, incurring loans exposes you to a certain level of risk. And the higher amount of loan, the higher the risk for default that you would face. So if you incur a significant amount of loan to finance the buyout, then basically you're exposing the company to higher risk. So the question now is, why would you do it? Because you'd rather expose the company to a higher risk so long as you are still the one who is in control. Okay, so as compared other strategies class, letter A is incorrect because a leverage buyout is not less risky. It actually is riskier. So that would tell us letter B and letter C and letter D are true. So normally you cannot obtain loans without using collateral, and what you will use as collateral would be the company's own assets. It's basically you are financing yourself. The company is financing itself. So the reason there's higher risk is because if you have a loan, you will have to pay high amount of interest. So much of your cash flow will be tied up with servicing or paying your interest, leaving little amount for investments or for projects. And that makes leverage buyout um, riskier. So you normally do this to avoid a takeover also. Number two, the company is concerned that the company is concerned that another company will try to acquire it. To reduce the likelihood of being acquired, the company's board of directors votes to borrow a large sum of money and pay that money out as a special dividend to existing shareholders. So here, you're not really buying back the shares. You borrow money and you're just giving it to the shareholders. So the question now is, what tactic is the company using? Uh, from what we've discussed in number one, we might have a hint that this would involve leveraging because we're borrowing money. Normally, class, if we mention leverage, we're talking about uh, debt class. If you can recall your financial leverage, it takes into account the amount of borrowings. Okay, but of course, the term leverage could be used some other way. But again, commonly, more often than not, when we talk about leverage, it would have to do with your borrowing or debt. Debt. Okay, so the answer here would be leverage recapitalization. So you're not really buying back the share. That's why this is not considered as a buyout. You are borrowing money to give it back to your shareholders. Now, how does that discourage a takeover class? As what we mentioned, you will be increasing your borrowing class. So definitely your debt will increase, and any company seeking to acquire another company class would be discouraged to acquire a company that has a that has a high debt ratio class because 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 there is a risk associated with incurring debt, one of which would be your default risk. And again, if you have high borrowings class, you will have to incur high interest. So even just from that simple analysis class, increasing borrowings would make a company less attractive. Number three, the company is concerned that another company will try to acquire it. To reduce the likelihood of being acquired, the company's board of directors votes to give executives huge bonuses in the event the company is acquired by another company. What tactic is the company using? So basically, it says the executives are given huge bonuses in case the company is acquired. So it's like someone is preparing an escape plan. And if we're talking about escape, it's the other way around. If we're talking about a parachute class, what idea that does that give us? It is a means of an escape. Normally, you would think of a parachute when we're giving a scenario wherein you have an airplane that is about to crash. So here, you do not care anymore what will happen to the company. What you're after is that you have something of value as you try to make your escape. Once the company is taken over with, you will no longer be involved in the uh, management of the company. So, some sort of a retirement plan for you. You make um, you give yourselves huge bonuses. So if you're trying to prepare an escape plan, the tactic that is being used there is what we refer to as a golden parachute. As I've mentioned, it's not even difficult to make this association class. Okay, you pay out huge amount of money, hence the term golden parachute for the takeover. And by doing that, you're making the company appear to have huge amount of expenses and potentially uh, discouraging a takeover. Number four, which of the following would be the most like, how many items is this material? 64 only. Which of the following would be the most likely benefit realized from a conglomerate merger? So a conglomerate merger class is a merger between two companies that are unrelated. So the keyword here would be unrelated industries or businesses. Uh, what's the question? Benefit realized from a conglomerate merger. So unrelated businesses or industries would merge into one. So what would be the most likely benefit? Letter A is not the answer, class, because you are not helping one another because in the first place, you are players in different industries. Even if you merge into one, the existing suppliers or the services provided by that company will not necessarily help the other party in the merger. So definitely letter A is not correct. Letter B, greater ability to dictate prices to customers. Here, you're not becoming a bigger player in the same industry. So you will not become the bully. You will not be able to achieve some level of monopoly. So definitely, even if you combine with another company that is from an unrelated industry, it does not give you a better ability to dictate prices. Because in the first place, you're dealing with different products or services. The same for letter C, economies of scale in production. You are not helping one another in the production of your goods. So this is not a likely benefit for a conglomerate merger. What it gives you out of these choices would be that it will provide you with greater diversification of product offerings. So the answer number four would be letter D. But what's the main takeaway here? Is your familiarity with the term conglomerate merger. What makes it a conglomerate merger? If it involves businesses from unrelated or different industries or businesses. Okay, for you to correctly analyze the answer to this question, it requires that you are familiar, you have an idea as to what a conglomerate merger is. But maybe perhaps you could have figured this out from the choices because letter A, B, and C gives you an idea of more of a vertical merger class, and the only odd choice here is letter D. But again, it's better for us to immediately know how to approach the question, and to do that in this question, knowing the description of a conglomerate merger is helpful. Number five, which of the following would be the most likely benefit realized from a vertical merger? So when we say vertical merger, just try to imagine the supply chain class from the production, different levels of production until the consumer. If you acquire anyone along the supply chain, then we consider that as a vertical merger. And if we do that, we're basically uh, streamlining the production process, thereby improving your production class. So if we are to compare a vertical merger from a conglomerate merger class, for conglomerate, we're dealing with different businesses. Here, in a vertical merger, this is a company, this is a merger between companies involved in uh, providing similar product or a company and its supplier class. So if you belong in the same supply chain, then that will be considered as a vertical merger. And this is basically what is being described in the benefits provided in choices A, B, and C number four. So let's go over the choices for number five. Less reliance on outside suppliers. This is basically the answer already. Because if you can acquire one of your supplier, then that is what is being described in a vertical merger. Letter B, uh, uh, this is incorrect because again, this is more appropriate for a conglomerate merger. Letter C, why is letter C wrong? Because in vertical merger, it's someone below you or above you in the supply chain. For economies of scale in production, it has to be someone similar to you, to your position in the supply chain. So if you have a competing company that has similar production capabilities, then by acquiring that competitor, then you would be able to achieve economies of scale because you'll be able to increase your production. For letter D, uh, it's very difficult to imagine how a vertical merger would lower variability in your annual sale. So again, the answer for number five is letter A. Number six, the DIL company operates candy stores and the BTX company produces automobiles. The two companies decide to combine to form a new company. We should be able to answer this already. Which of the following is the best description of this transaction? The answer is a conglomerate merger. So again, I'm not sure if you've encountered these terminologies before, and this is, I think, what I've told you before. When you take the CMA exam class, you will feel some level of expertise. Okay, imagine you know these terminologies, and even when you try to talk to someone, they would not have any idea of what you're talking about. You could say, maybe I'm an expert and they just know nothing. Question is, will this have any use for you? Hopefully. Query number seven. Which of the following makes a firm less attractive to acquiring firms by taking out a significant amount of debt and distributing large cash dividends to shareholders? This is what we describe as your leverage recapitalization. This is letter C. Number eight, which of the following is a defense against corporate takeovers that still results in the firm being acquired by another firm? Okay, so in Golden Parachute, we do that to try to discourage your acquirer. The same for your leverage recapitalization. The same also for your poison pill. So the answer in number eight is your white knight defense. Okay, and again, that's what I've told you. It's very easy to make the association here. What's the first thing? What's the first thing you think of, class, when we say the word knight? It is someone that will come to your defense, your knight in shining armor. So, what does this tell us? In the White Knight Defense class, it involves the targeted company to find a friendly buyer to outbid anyone who would want to acquire the target company. So here, even if the company would still be acquired, but we would say it's okay because it is with my knight in shining armor. So if I would be taken away, let it be by someone I would want. So I hope you'll be able to easily find the association here. Number nine, the KGE company is concerned that another company will try to acquire it. To reduce the likelihood of being acquired, the board of directors voted to elect only a portion of the board every year. What tactic is the company using? The answer for number nine is staggered board of directors. So companies will sometimes use this class. So in a staggered board of directors, uh, it will be difficult for the existing shareholders or a potential buyer to elect the majority of the board because the 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 company that will be acquiring will not be able to make the appointment at the same time. So they would not be able to easily obtain control of the votes in the board to approve to allow a takeover. But from the definition, from the scenario given in number 9 class, it would be very easy for you to figure out that we are talking about the staggering of your board of directors. And this would be my tip to you class. For this topic, uh, whatever you be able to think of, most likely that is the correct association class. You have so many questions for definition of terms wherein you would think that the choices are trying to trick you. You would say, it's too obvious to be that answer. This choice is too obvious to be the correct answer. I'm telling you, for these kind of topics, the answer is too obvious, class. So please do not refuse the blessing given already in the exam. The CMA exam will not try to trick you, class. The CMA exam will not try to trick you. Okay, you might think, I did not study this topic. There's no way I can figure out this answer. That's incorrect. For this topic, you can trust yourself. The answer can be obvious, especially for this kind of topic. The CMA exam can fail you, but not because of this petty trick of trying to trick you plus into thinking, oh, this is what I am describing. I am going to give you a very obvious term associated with what I am describing, and that would not be the answer. Again, that will not happen. Okay, your problem lang would be if you are so out of touch that whatever association you do is not what almost everyone can think of. So just think like a normal person. Okay? Do not say that this could not be the answer because it's too obvious and the question might just be trying to trick me. That's not how the CMA exam will play out, guys. Okay? Number 10, when two firms in the same industry are combined, it is referred to as what type of uh, merger? Uh, the answer here is definitely not letter C. But based on what I've mentioned earlier, you might think that it's letter B. But if we're really talking about the same industry class, the best answer here would be your horizontal merger. If we talk about vertical merger, it should be someone above you in the supply chain. So that supplier may not be necessarily from the same industry. So if we're going to be very strict about it, when we talk about a combination between two companies from the same industry, the best answer here would be your horizontal merger. Number 11, which of the following will be the most likely synergy realized from a horizontal merger? I've already given you an idea with this one. And the answer here would be your economies of scale in production. If you're uh, providing the same service or producing the same product, if you're doing the same activity, if you combine your first forces, you may be able to achieve economies of scale. And I hope everyone has an idea as to what we mean by economies of scale. Basically, cost will go down as the level of production goes up. Number 12, the XYZ company buys all the stock of the ABC company and the XYZ company remains in existence after the transaction. Which of the following is the best description of this transaction? Our answer here would be uh, in your business combination class, our answer here would be an acquisition class. Number 12, the answer is an acquisition. So in an acquisition, basically this would be your consolidation class. One company buys a controlling interest in another company. Okay, of course, the acquirer would still remain, the acquiring company will still remain in existence, the same as the one being acquired. Number 13, when two firms are combined that are from different industries, it is referred to as what type of merger? The answer here is conglomerate merger. Number 14 was the question. The scenario most closely describes a publicly traded company is planning to divest its division A for 100 million. Private investors have pooled their capital of 10 million and plan to finance the balance of 90 million via debt financing with Division A's assets as collateral. The new owners plan to give the new management a bigger stake in the company by providing stock options. They also redesign performance measures and incentive schemes for employees to minimize inefficiencies and bureaucracy. The scenarios most closely describe A. This would be our leverage buyout. We are incurring a huge amount of debt. Number 15, the XRF company is concerned that other company will try to acquire it to reduce the likelihood of being acquired. The board of directors votes to make all its debt redeemable in the event it is acquired. So what happens if your debt becomes redeemable? But the moment it is acquired, then the debt holders can compel you to pay off the existing loans. So the part of the acquirer, the moment they step in, they will be faced with a significant amount of payables. Instead of the term given in the borrowing, most of them can be immediately due and payable because of this provision that the debt will now become redeemable. So what are you doing here? You're obviously making the company less attractive because the moment somebody takes over, it will basically signal the death of the company class. And since I mentioned the word death, you should be able to figure out that the answer here would be a poison pill. So imagine you acquire a company and all you have to do would be to pay off all the liabilities of the company. So that would definitely cripple the operations of the acquiring company. Number 16, the company operates stores that sell women's clothing, and the ASW company produces women's clothing. The two companies decide to combine to form a new company. Which of the following is the best description of this transaction? The answer here is one is selling and the other is producing. Okay, so this is your vertical merger. Okay, so imagine this is the first question you have encountered, class. You're already given with a scenario, and if you were not familiar with the terms, class, you would really have a difficult time figuring this out. But maybe not that much. Okay, again, vertical, you can already visualize the line, class. Just imagine the line as the supply chain. 17, when two firms that make different parts used at different stages, that make different parts used at different stages of the manufacturing process for the same finished goods are combined, it is what is referred to as what type of merger? This is still your vertical merger. You are still along the supply chain. Tagana, if you are at the same level in the supply chain, that will not be considered as a vertical merger. It should be companies from different levels or parts of the supply chain. Number 18, which of the following is a strategy wherein a firm elects only part of its board each year? We have already answered this one. This is your staggered board of directors. Number 19, the company and the work company both sell children's clothing. The two companies decide to combine to form a new company. Which of the following is the best description of this transaction? Do they perform the same thing in the supply chain class? Yes, so this would be considered as a horizontal merger. Number 20, the company STQ company and the BGT company both sell specialty glassware. The two companies decide to combine to form a new company. Which of the following is a description of this transaction? This is still your horizontal merger. 21, the company is concerned that the VBF company will try to acquire it. To reduce the likelihood of the company being acquired, AOW tries to convince the DWQ, so we have three parties here, to outbid VBF. What tactic has AOW used? This is the White Knight defense. 22, which of the following would be the most likely synergy realized from a vertical merger? We've answered a similar question already. Uh, the answer here would be you will have less reliance on outside suppliers because basically your supplier has been incorporated already to the combined company. 23, an acquisition takes place when a firm buys a controlling interest in another firm. Okay, again, this is basically our stock acquisition. 24, making all debt redeemable in the event of a firm being acquired is part of which type of defense against corporate takeover? This is your poison pill. 25, which of the following provides very large payouts to executives released as part of an acquisition? This will be your golden parachute. 26, what's being asked here? You should use the time value of money factors. The company is considering purchasing BJF company. SHSW estimates that BGF will generate net cash flows of 75 per year at the end of each of the next 5 years. In addition, the terminal value of all cash flows after year 5, including, where is this? Including non-operating assets is estimated to be 400,000 as of the end of year 5. If HSW uses a discount rate of 10% to value this acquisition, what is the maximum amount? So basically, we're trying to determine the price of the company. What have we discussed before? Bond acquisition, we try to determine the price of a bond. Stock acquisition, we try to determine the price of a stock. And what have we done in those situations, class? We just get the present value of the cash flows that will be given by the bond or that will be given by your stock. What cash flows are given by the uh, bonds? You have your interest and the principal payment. What cash flows will you derive from a stock, the dividends, and the ultimate selling price? Here, for a company, if you want to acquire a company, the same. Get the present value of the cash flows that you will get from the company. And what would that be? Your operating cash flows. Okay? And here we are given with the net cash flows, class, every year. And we also have the terminal value. The terminal value is basically what we would receive at the end of the fifth year when everything is disposed of. So we have two sets of cash flow, which is your annual cash flow and your terminal value. Okay, so since you will be receiving 75,000 from this company for 5 years, obviously you would not be using the factor for single sum. What should you be using? You should be using ordinary annuity. And what should you use? The present value factor or the future value factor? Present value, because again, that's the goal for any valuation class. Get the present value of the cash flows that you would get from that investment. So what do? You multiply 75,000 with 3.791. How much is 75,000 times 3.791? 284, 325. So please take note of that amount. That is not yet our answer because aside from receiving 75,000 per year, we would be receiving a terminal value of 400. Okay, that is the amount that you would get as of year 5. Okay, all the other future cash flows as of year 5, it would be 400,000. Okay, it's as if they are lumped into a single amount. Okay, so what do you do? Since 400,000 is still the value of that cash, the terminal value as of year 5, you have to bring it back to year 0. How do you bring the cash flow from year 5 to year 0? By getting its present value. Are we still going to use the ordinary annuity? Not anymore, because again, your terminal value is basically the lump sum value of all your future cash flows after year 5. So here we will be using the present value factor for lump sum. So that would be 0.621. Multiply that with the terminal value of 400,000. How much is that present value? 248,400. And you add that one with the present value of your 575,000s. How much was it, class? 284, 325. You add that with 248,400. How much will that give you? 532,725. Okay, so this concept is not new to us, class, but it's just applied in a different scenario. And what scenario are we talking about? The acquisition of another company. 27, which of the following types of business divestitures takes place when a firm creates a new company based on one of its product lines? And this is what I've told you. Even from your experience in life, not related to accounting class, you can figure this out. Okay, you watch a lot of series class. If you're able to create a new show based on its old show, what do we call that second show, class? It's a spin-off, and that is already the answer. Again, you may think there's no way that that would also apply here. Again, the associations here, class, are the same associations that a normal person can come up with. It's not like medical terms, but you really, it would be very difficult for you to figure out unless you're very good with Latin or French. You will not have any idea of those terminologies. 28, the company is evaluating an investment proposal for the current year. The relevant data follows. Uh, the initial investment would be 30,000. It would be depreciated on a straight line basis over uh, 6 years with no salvage value. The before tax annual cash inflow due to the investment is 10,000, and the income tax rate is 40% paid the same year as incurred. The desired rate of return is 15%. All cash flows occur at year end. How much would Apex have had to invest 5 years ago at 15% compounded annually to have 30,000 now? The process is very long. Plus. This should be more on the net present value uh, computation. Let's see. Uh, what we need is to get the price. How much would be the investment? Uh, how much would be the investment before, so that we will have 30,000 now? Oh no, it's actually very straightforward. We're just trying to get the present value of your 30,000 plus present value of annuity in arrears. Uh, yes, this is the challenge here. What PV factors are given to you? Present value of an annuity. And then annuity factor for 5 years. But what we have is a singular cash flow class wherein you will have enough. We're not talking about the investment yet. What we need is we need 30,000 today. What should we have done 5 years ago so that we would have 30,000 today? Okay, we're not talking about whether or not we should make the investment being described in this problem. Okay, what is being asked is what should we have done? Oh my God, is this 5 years? I don't know, 5 years ago, so that we would have 30,000 by now. So basically, you're trying to ask what's the present value of a 30,000 cash flow on year five as of year zero. Okay, so basically, you just get the present value using the lump sum factor and multiply it with your 30,000. But you're not given with the lump sum factor class. What is given to you? You're given with your uh, you're given with your annuity factor. And basically, what this problem is testing you class is whether or not you know the relationship between your annuity factor and your PV factor. What's the relationship between your PV, your lump sum factor and your annuity factor class? The annuity factor is just the summation of your lump sum factors. For example, if you're given with a if you're given with a 2-year annuity factor class, what does that mean? The 2-year annuity factor class is just the sum for your 1-year factor, one year lump sum factor and your 2-year lump sum factor. Uh, so this means that your 5-year factor class is the sum of your 1-year lump sum factor, 2-year lump sum factor, 3-year lump sum factor, 4-year lump sum factor, and 5-year lump sum factor. That is why your lump sum factors class are always lesser than 1. That's why your lump sum factor is always lesser than 1. Okay? Your lump sum factor is always lesser than 1. Whereas your annuity factor would almost always be greater than 1, but always lesser than your number of years. What do I mean? Look at the factors given there. For year 1, the factor is 0.87, which is less than 1. For year 2, it is greater than 1, but it is still lesser than 2. For year 3, it would still be greater than 1, but it's lower than 3. For year 4, still lower than 4. For year 5, lower than 5. Okay? That's how your annuity factor behave class. They would normally be greater than 1, but they would always be lower than the n or the number of years. Because what's happening? Your annuity factor is just a summation of your lump sum factors class. Okay? I've given you the table before. I want to demonstrate it class, but I also want you to just trust me class. Your annuity factor is just the sum of your lump sum factor. Okay, let's just demonstrate. You laughed when I don't think you trust me on this one. Di ba I've given you a table of factors before? Where is it? Factors. PV. Okay. Table 1 is feature 1. Let's not talk about feature 1. Let's go to table 3 and table 4. Class. Are you able to pull it up, class? Even with just 1%, 1% 1 year, how much is your lump sum factor? Table 3. Okay, 1% 1 year, it is 0.9901. Do you see that, class? Okay, and then if you go to table 4, what is your annuity factor? 1% for 1 year lang. Still the same. Because again, your annuity factor is just a summation. But if we're talking about 1 year lang, then the lump sum factor and the annuity factor for 1 year would be the same. Go back to table 3. Let's try 2 years. Still at 1%. How much is your uh, lump sum factor? Table 3. Lump sum factor for 1% at 2 years. It would be 0.98 9,903. Okay? You add that with the lump sum factor for year 1, still on table 3 class. How much was the factor for 1% at 1 year? It was 0.9901. Then if it's 2 years, it's 0.9803. Please do this class. Add 9901 and 9803. I will not look at table 4 yet. Give me the sum of the two. 9901 and 9803. 1 point, is it 1.8 or 1.9? 1.9704. Okay, hopefully that's the amount that will be found on table 4. Table 4, year 2, 1%, still 1.9704. Because again, your annuity factor is just the summation of your lump sum factors. Okay, if you have an annuity, it's just the same as getting the individual present value of your periodic cash flow. But to simplify, as a shortcut, we have the annuity factor. If you still do not believe me, class, let's try 20%. Okay, at least it would be smaller. What's 20% in 1 year? Go back to table 3. Lump sum 20% 1 year, it's 0.8333. Go to table 4. It's the same because again, if you only have one thing to add, it will just be the same. Let's add year 1 and year 2 for your lump sum. 0.8333, and then for year 2 it would be 0.6944. So this would be 1.5277. 1.5277. If you go to table 4, 20% at 2 years, you might say, sir, dilagin mo ako, sir. Because what I said was 1.5277, and what is here is 1.5277, and what is always our explanation, class? Rounding off errors. Again, the logic there is the same. Your annuity factor is just the summation. So what are you supposed to do in answering the problem here? Okay, you're going to get the difference between the annuity factor for 4 periods and for 5 periods, class, to get the present value for year 5. So, what's the annuity factor for year 5, class? 3.353. And then for year 4, it is 2.856. What's the difference, class? 3.353 minus 2.856. 0.497. And what does that represent? That would represent our PV factor for lump sum for 5 years. So that is the amount that you would multiply with your 30,000 to get the present value. So 30,000 times 0.497 would be 14,910. Because when you take the CMA exam, you have access to the PV factor table, man. So you can just simply go there having to figure out the relationship between the annuity factors and the uh, lump sum factors. So the answer here is, how much is 30,000 times 0.497? That should be less than 15,000. How much? 14,910. So the answer there is letter B. Number 29, which of the following types of business divestitures would the firm use in order to most effectively monitor the performance of a strategic business unit? We already know this is not spin-off, class. Okay? Now, what is it trying to describe, class? Most effectively monitor. Out of the choices, class, which choice would you be able to associate with the word monitor, class? Tracking, and that is already the answer. And this is the possible pitfalls, kasi ba? You have your backer, you try to answer, you chose this topic, then you do not have any background, you try to answer, then you get the correct answer, then you say, maayo naman kayo ko. No need to continue practicing. Because while it is true for this topic, for some topics you really have to have an existing idea. Okay. While confidence is good, class, even overconfidence is good so long as it is justified. Number 30, what's the question? Which of the following is a qualitative consideration that may result in CDL making the purchase for 820,000? So what's happening? The company is trying to decide whether it should acquire another company. It performs a discounted cash flow analysis and determines that the value of the target is 760,000. The target company has indicated that the minimum price it will accept is 820. So guys, based on your computation, based on the discounted cash flow, you say that the value of the company is 760. But what is the acquiring saying? You can only buy me for 800, 820. So basically, even though your financials tells you that this company is only worth 760, but they are only willing to sell for 820, the question now is why are you still willing to buy that company when from your own valuation, you believe that it is overpriced? So there must be something that's because again, our logic here is that these people are not crazy. Why would they buy something for 820 when their value is only 760? There must be something, and that if it's not supported by financials, it has something to do with qualitative consideration. So which one would be the answer here? Let's say, let's see. Letter A, CDL thinks it may have underestimated the increase in revenue it could generate from the target's distribution. No, that is not qualitative class. Letter B, CDL thinks it may have underestimated the decrease in cost it could real again. Still talking about figures class. So that would not be a qualitative consideration. Letter C, the company has a relatively decentralized company culture and the target has a relatively centralized company. Is this a qualitative consideration? Yes. But will this convince you to overpay class? No. So the answer here would be letter D. The company thinks that the target's management team is well experienced and highly qualified. You're getting more from the company not because of its financials, but because of the people behind the company that you are targeting. So the answer number 30 is letter B. Then you ask yourself, could I have figured this out even without encountering this question previously? The answer is yes. Do you agree? It's okay for you not to agree. Okay? At least it would make sense for us to be doing this review. If you all agree, then it's like saying we don't need this anymore. Number 31. In which of the following types of business divestitures does a firm sell a minority interest in the newly created firm? Class, what are you doing? Uh, Sell a minority interest. You're taking a small chunk class or a small part. In doing that, what word can you associate class? It's like you're carving out something from the company. And the equity, the word equity there is the final giveaway. Okay, you're talking about minority interest. Okay, so the answer here is letter B. 32. There are four main divestiture options available to companies: spin off, equity carve out, tracing stock, and split up. Under which option or options is a new company created? Uh, if you go back to our 31, what did it say? Sell a minority interest in the newly created firm. So from that alone, we would know that in an equity carve out, there will be a new company that will be created. So that means letter D should not be the answer. So the question now is, aside from equity carve out, which one would still result in an additional company? If you can recall, class, what happened in spin-off, class, you would also be creating another company. So, but that does not help us. Okay, A, B, and C all has spin-off. So what would be the other item now? The answer here would be letter B. In a split up class, you split into two new companies, or maybe it can be more. But the main feature there is you will have new companies, and the old company or the original company will cease to exist. Okay, so but for these three, split up, carve out, and spin off, you will have a new company. 33, the company is broken up into JIO and POI. Shareholders of QYU exchange their shares for shares in JIO and POI. Which of the following is the best description of this transaction? This is now our split up. The old original company here is your QYU, which is split into JIO and POI. 34, the company is considering purchasing. Is this the same thing? I think it's just the same class as what you did. I hope I'm correct. So I'll just give you the answer. The answer here is 375,850. 34 is 375,850. 35, the AIK company decides to issue a stock. This is based on one of its most profitable business units. AIK retains ownership of the entity, but the stock is sold on the open market for cash. Which of the following is the best description of this transaction? You decided to issue a stock that is based on one of its most profitable business. Uh, what are the choices? We know that this is not a spin-off class. No, actually, you might be able to think it's a spin-off. We know that this is not a split up, okay? Because we're not splitting the original company into multiple companies. We know also that this is not an uh, equity carve out because you're not selling your uh, minority interest. So you might think that this is a spin-off because this is based on one of your most profitable businesses. Uh, but here, there is no new company class, so this cannot be a spin-off. So the answer here would be letter C, a tracking stock. 36, which of the following statements is true of the business valuation principle? Let's see. The value of a business does not change over time. Definitely wrong. Otherwise, many financial analysts will be out of jobs. Letter B, the value of a business is solely affected by mergers financing decisions. No, there are a lot of considerations, internal and external. Letter C, the fair market value of a business is the value of that business to a hypothetical person who is knowledgeable about the business. Sounds and appears true, but let's just go over D to make sure. Estimating the fair market value of a business always includes the value of synergies or the effect of any uh, investor specific management styles. Estimating the fair market value of a business always includes the value of synergies or the effects. No, you can have quantitative only. So the best answer here would be letter C. 37, which of the following is not a quantitative factor to consider when quantity uh, to consider when evaluating a business combination. So when we're talking about quantity, this has to do with numbers. No, we're looking for one that is not. Okay, and right from the start, we're given with letter A, strength of the management team. Is that quantitative class? No. So this will already be the answer. So again, this is one of those questions that you can really figure out on your own. 38. So if you can figure this out on your own, even without prior preparation class, what are we doing here? For you to develop the confidence class to trust in your judgment. 38, when using the discounted cash flow method to evaluate a business combination, what is the appropriate assumption about longevity of the target firm? For me, this is very important concept with class. Since your first year, you should be introduced to this one. Your going concern assumption, and what is under the going concern assumption that the company has an indefinite life. So the answer here is letter D. 39, the company is trying to decide whether it should acquire the company. Which of the following is a qualitative consideration that may result in OKJ not making the purchase for 750? So you say that it's worth 850, but it is only priced at 750. So you're now asking the question, why would I not decide to buy it even at a lower price than the value that I have assigned to it? Let's see. OKJ is a well-established company that has been in existence for over 100 years, and the target has been in existence for uh, less than 5 years. Maybe this can be true for lack of alignment, and considering that the acquiring is still at the initial stage, there is not enough information to support to determine its correct valuation. But just to be sure, let's try to go over the other choices. OKJ thinks it may have overestimated the increase. This could be the reason why you would not proceed. But the problem is this a qualitative consideration? No. Letter C, OKJ thinks it may have overestimated the decrease in cost. Again, the decrease in cost. This may be a reason why you have overpriced the company, but again, is this a qualitative consideration? No. Letter D, OKJ thinks that the target's management team is well experienced. Basically similar to what we discussed earlier. If it if we're giving premium to its management team, then we should be willing to pay a higher price. But here we are not even willing to pay the lower price. Okay, this would primarily be because of lack of alignment. So the answer would be letter A. Number 40, which of the following is not a type of business divestiture? Uh, Answer is letter D, merger. 41, below are three possible benefits of a divestiture. Which of the following is a company likely to accomplish with a split up? What happens in a split up? One company is split into several companies. What will happen? Uh, a company wants to raise cash. No, I don't think split up will give you cash. Will result into more cash. You're not uh, more money is not going into the new companies. It's just the assets of the old company being split between the new companies. A company wants to avoid government intervention. This is possible. For example, if you've grown too big, that you now fall within the coverage of the anti-monopoly laws of the state class. So you break it down to skirt through anti-monopolies. So this could be true. A company wants to be more focused. This could also be true. So the answer here would be, we don't have two only, correct? So the answer here could be 2 and 3. Letter A. 42, which of the following is not a common reason that business combinations take place? Increase revenue, that's correct. Decrease cost, that's correct. Letter C, expand market share, that is also correct. Government regulation, no. The bigger you are, class, the higher the chance that you would be subject to more government scrutiny. So the answer here would be letter D. 43, for some reason I don't have the mood to answer problems today. Liberty should record the above sale in January year one at what's happening? On January 1, year one, Liberty Company sold one of its product lines to Bell Corporation in an arm's length. So you think, sir, that's what we feel almost every day. Sir. Bell signed, but you don't have. I have a choice because you still don't have that choice. Bell signed a non-interest bearing note requiring payment of 20,000 annuity for 10 years. The first payment was made on January 1, year 1. The prevailing rate of interest for this type of note at that date, at the, at the date of issuance was 12%. Information on present value factors is as follows. So the payment on year 1 is 20,000. Liberty should record the above sale. So what's uh, this is 10 years and then requiring payment of 20,000 annually for 10 years. And then, uh, okay, I get now. You are on January 1, year 1. And then, what are these factors that are given to you? Present value of 1 and present value of ordinary entity. Okay, so, uh, because this would serve as annuity due class or advance because the first payment is on year 1. And this is, no, you don't have the annuity. This is where your understanding of the annuity due factors are tested, class. But we don't have the table for that one. Class, your annuity due factor, uh, your 10-year annuity due factor, class, is just the same as your 9-year ordinary annuity plus 1. That's it. Because in annuity factor, the first cash flow happens on year 0, and we know that the present value of a cash flow today is just equal to that cash flow. 100 today is 100 today. The present value of 100 today is 100. Okay, that's why the difference between your 10-year annuity due factor is just your 10-year annuity due factor is just equal to your 9-year annuity due factor plus 1. Okay, and that's basically what is being tested here. You need the annuity due factor here, but you are not given with the annuity due factor. So what are you supposed to do? You get the 9-year ordinary annuity factor and you add 1. How much is the 9-year ordinary annuity factor, class? It's 5.328. You add 1 to 5.328, that will give you 6.328. You multiply 6.328 with your periodic cash flow of 20. Please do that, class. Hopefully it gives us the correct answer. 20 times 6.328. How much? 126,560. And that would be the answer. So basically this question is testing your understanding of the relationship between the ordinarity annuity factor and the annuity due factor, class. Because your annuity due factor is basically you will have In this problem, you will receive 20,000 at the end of each year for 9 years. But why are we saying you will receive 10? The first cash flow will be on year 0. So you get the annuity factor for 9 years, you add 1 so that you will have a 10-year annuity due factor. And again, just trust me on that one. 44. What's the question? You should use the time value of money. How much net value is it creating for its shareholders? So what's the given? Is considering purchasing income. HEA estimates that RO will generate net cash flows of 60,000 per year at the end of each of the next 5 years. And the terminal value of all cash flows, no, we've had the same problem naman, di ba? So the answer, I'll just give you the answer. The answer here is 57,960. 45. Are there more problems down the road, class? Let's answer 45. See, let's answer this so that we can skip some of the other questions. So, you will pay 450,000. That's your investment. Let's see how much cash flows you'll be able to generate. It says here 80,000 per year at the end of each year. And then the terminal value of the cash flows at the end of 5 years, which is 350. So what do we do? Multiply 80,000 with our ordinary annuity factor, which is already given to be 3.791. How much is 3.791 times 80,000? Use the time to practice na lang. 3.791 times 80,000. How much? 303,280. Next, you add the present value of the terminal value. How much is the terminal value? 350. Since a terminal value represents a singular cash flow, we will be using the lump sum factor. So 350 times 0.621. How much will that give you? 217,350. Add that with your 303,280. The cash flows that will be the present value of the net cash flows that we will get from the investment would be 520,630. Considering that we paid 450, we invested 450,000 for this venture, we have a net benefit of 70,630. And basically, class, what we did there is similar to what you do when you solve for the net present value. Now, is the computation of the net present value part of the subject? I don't think so. But you would still end up using that same principle. Let's have 46. Looks familiar. So can we skip? 46. No, the choices are different. What's the question? Assume the company uses a discount rate of 10 to value this acquisition. You should use, what's the question? If CTN demands a purchase price of 750, should the AF? Okay, so they're trying to make us decide. So I think the same procedure. Are we given with the terminal value? Yes, 600. What do we do with the 600? Multiply with the factor. Is this still 5 years? Yes, so 600 times 3.791. No. Lump sum. Lump sum is 0.621. How much is 600 times 621, class? 372? 372,600. Then we have the periodic cash flow of 90 multiplied by the same factor of 3.791. How much is 90 times 3.791? 341,190. Then you add that with our 372,600. The total cash flows from the business would be 713,400. 713,790. So, should you be willing to pay for it? No, because the price is 750 and it is only worth 713,790. So 47, what's happening here? Is planning to invest 120 in a 10-year. Okay. Scott estimates that the annual cash inflow net of income tax from this project will be 20,000. Desired rate of return on investment of this type is 10%. Information on the present value factors is as follows. Let's see. Let's try. I think you would need trial and error here. Uh, do we have two sets of cash flows? No, we only have one, which is your annual cash flow of 10. Okay. Okay, you need to try for both 10% and 12%. So multiply 10%, the factor for 10% class, but for annuity with 20,000. How much is 20,000 times uh, 6.145? How much? 1, 122, 122. How much? Okay, but it's greater than 120, correct? Okay, and then if we use the 12%, how much is 5.65? Is it greater or lesser than 120? Lesser. Okay, so we know it's if we use 10%, it goes beyond 120. And then if we use 12%, then we will be less than 120. So that means the interest rate that would make the present value of your 10 20,000 equal to 120,000 is lesser than 12% but greater than 10%. It's in between 10 and 20. So the answer here would be letter D. Remember, because the higher the interest rate, the lower the present value. So since at 10% it's already higher than 120. So if our target is 120, then our interest rate would be higher than 10. But if it is at 12%, it would now be very low. It would already be below 120. So the interest rate that would make the 10 20,000 equal to 120 is lesser than 12%. But we know that it's greater than 10. 48, below are three possible benefits of a divestiture. Have we encountered this already? Benefits of a divestiture. A company wants to raise cash. If you divest, you will be converting your investment into cash. So this can be correct. Next, number two, a company wants to make it easier to value a portion of the business. Yes, you can achieve that by isolating that part of the company. And number three, a company wants to be more focused. Uh, Accomplished with a tracking stock. Sorry, it specifies tracking stock there. If it's tracking stock, one could also be correct, and number two, also that's correct. No, if you want to be more focused, you should be letting it go. But in tracking stock, you're not letting it go. So the answer in number 48 would be 1 and 2. So that would be letter B. 49, which type of divestiture does not result in a new entity being formed? We've already answered this similar question, correct? The answer is tracking stock. 49 is C. 50, which of the following statements concerning spin-offs and equity carve-out is correct? Uh, in a spin-off, shareholders of the existing company receive shares of the new entity, but in an equity carve-out, shares in the new company are sold on the open market. Sounds correct. Okay, let's just go over the other choices to make sure. In an equity carve out, shareholders of the existing company receive shares of the new uh, company, but in a spin off, no. In carve out, you're selling it, the minority interest to outside parties. Shares in the new company are sold on the open. It's the other way around. So A and B definitely cannot be true at the same time, class. And we're saying A is true, so B is definitely incorrect. Letter C, shareholders of the existing company receive shares of the new company in spin-offs and equity carve-outs. No. Shares in the new company are sold on the open market in spin-offs and equity carve. No. The answer number 50 is letter A. 51. Is this qualitative still? I'll just give you the answer this because I trust that you can analyze this already. 51 is QUG thinks that the target's management team is not as well experienced as its management team. So the answer here is letter A. 52, which of the following is least likely to be a reason for a company to do a split up? 52, a company is trying to raise cash. Least likely reason. Okay. The answer for 52 is letter A. How many items is discussed? 64? 53, which of the following statements concerning tracking stock and equity carve out is correct? Answer here would be a new entity is created with an equity carve out, but a new entity is not created when tracking stock is issued. Answer is letter A. 54, below are three possible benefits of a divestiture, and what kind of divestiture is being asked in number 54? It's an equity carve out. A company wants to keep control of a growing portion of the business. No. Uh, which of these is a company likely to accomplish with an equity carve out? Carve out. A company wants to keep control of a growing portion of the business while making it easier to value that portion of the business. Uh, this could be true. Let's see. A company wants to raise cash, definitely. A company wants to distribute an entire business area to its existing shareholders. No, it's not your existing shareholders. Okay, we're sure that the answer involves two, but there's no two only. We know that it does not involve three, so the best answer here would be letter D, 1 and 2. 55, the HRS company creates a new entity called KJT Company out of one of its business lines. HRS sells 30% of shares in KJT on the open market for cash. Which of the following is the best description of this transaction? This is your equity carve out. 56, I think this is just the same. 275, 840. 57, which of the following types of business divestitures is often a result of government concern about monopolistic behavior? We've talked about this earlier. This is your split up. 58, which of the following is the best description of this transaction? Creates a new entity, so this should not be tracking stock, out of one of its business lines. Shares in KLP are distributed to DEH shareholders, so this should not be carved out. Uh, which of the following is the best description? Based on their ownership percentage. So you're just distributing it, so this would be your spin-off. We're sure it's spin-off and not split up class because the original company is still present. 59, which of the following statements is true about business valuation? The valuation of a business is based solely, no. There's a single value, no. There are different valuation models for any business, many of which produce different values for the same company. This is correct. 59, letter C. Number 60, which of the following is least likely to be a reason for a company to do a spin-off? Yeah, if you're doing spin-off, you will not be raising additional cash. So the answer here will be letter C. 61, which of the following is a type of business divestiture? Our answer here would be letter B, equity carve out. 62, which of the following is most likely to be a reason for a company to do an equity carve out? Uh, our answer here would be it is trying to raise cash. Answer is letter D. 63, which of the following is a qualitative consideration? Answer here would be LDE has a relatively decentralized company culture, and the target also has a relatively decentralized company culture. That's why you're willing to overpay for this company. Last number, finally, which type of divestiture involves distributing a stock dividend to a company's current shareholders? Uh, this would be your spin-off. Okay.